So you have better growth, stronger labor market, higher inflation, and yet we're cutting.
I mean, you have every cut possible priced in the market in the next year, basically. We can officially declare Trump the victor in his war against the Fed.
That's what it takes to delever this wartime debt. And the new mandate is here. It's front and center.
Now, there's so much noise on Fed Day. To me, the real signal is the Thursday afterwards. And here we are. It's bonds are getting sold off, equities are rallying, and small caps are leading the charge. Like it's game on in my mind.
Like we're not even to QE yet.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you then. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance. Finally, the trio's back together. I'm back after a week off. You guys did a pretty good job covering for me. I was dying laughing at the first 15 seconds of you guys' impression of me.
Our in-house lumberjack. I am Philip. Welcome to Forward Guidance.
That was good. You do it the best, though, so we're glad to have you back.
Thanks for that. Yeah, I missed you guys. I missed this. Tyler, you're in your new studio, new gig. What's going on, man? Life's good?
We got a whole new studio in here. It's pretty sweet. Podcast.
That's pretty sweet. That's pretty nice. They let you wear your kids' shirts to work like you do normally.
Yeah, there's no dress codes, eh?
Yeah.
Yeah. It's very differentiated. We think originally over here. Something you don't know anything about.
Yeah. Like you're Crocs or something like that.
What's Felix hair? What's this hair situation we got? I have to go out for the hair.
Yeah.
Is that like a
I got a haircut the other week. I was away. Yeah. I had to get freshened up for it.
I think it looks great.
Yeah.
Gotta get tuned up sometimes.
It's almost as nice as your Matisse paintings on the back.
Yeah. I had a comment the other day that was like, for how great your podcast is, you really need to make your background better. I'm like, man, I know. I want to get a sick bookcase with some cool smart guy books that make me look smart. It'd be awesome.
Dude, you're bland in the background, but your ideas are priceless, so don't worry about it.
Let the ideas work and try.
It sounds like a Valentine's Day card or something.
A little bit of housekeeping notes before we get into the swing of things here. I'm excited to be talking about Origin Summit, which Blockworks is the media partner in partnership with Story Protocol, happening next week in Korea. A few of us are going to be there doing some coverage, interviewing some folks. I'm going to be doing a fireside chat with Arthur Hayes, which will be fun. So, yeah, if you happen to be in Seoul that week, go check it out. Blockworks will have a good presence there.
Dude, you're going to Seoul, Korea?
I'm going to Seoul, Korea next week. Yeah, wow. Surprise. I know.
They're world traveling. Brooklyn to Seoul, Korea to London. Man.
It's busy days, man. It's busy days. But should be fun. Check it out. We'll have the links in the description and all of that. Alrighty. Let's talk about the Fed meeting. As expected, 25 bips cut. No surprise there. Actually, I saw some people starting to speculate about a 50 bips cut, which seemed kind of insane to me. I don't know where really that came from. Maybe it's pressure from the Trump admin or whatever. But yeah, I was not expecting 50. I don't know if you guys were. But what was really interesting to me, and I tweeted about this yesterday as it came through, but some really interesting notes. Obviously, September is a SEP update meeting. So we got an update on how they're thinking about the economy, where is it headed, what are they thinking for the path of interest rates going forward. And first off here, looking at their forecast for GDP, they are uplifting their forecast for GDP for 2025 from 1.4% to 1.6. For 2026, 1.6 to 1.8. 27 from 1.8 to 1.9. So higher growth than expected. At the same time, in 2026, the unemployment rate they're seeing going lower from 4.5 to 4.4. Inflation, they're seeing going higher in 2026. And, if you told me all those things in isolation, I'd be saying, all right, well, it makes sense for the Fed to pause at the very least. But no, in fact, they're actually increasing the amount of rate cuts that they're expecting over the next 2 years. So you have better growth, stronger labor market, higher inflation, and yet we're cutting. That sounds like a positive to me, Tyler. What do you think?
We're 3 minutes in, and I can't drop the P-bomb just yet, but otherwise, the guys that are doing the Tyler drinking game are going to be hammered by minute 50. I think this is exactly what we said months ago. This is a new policy decision, which is you have to grow your way out of the debt and delever the government balance sheet. Even Moran, they even came and said there's a third mandate now, is exactly what we were saying, which is it's negative real rates and nominal growth. That's what it's all about now. And it's the cat's out of the bag. We got Moran saying, we're going to 5 eases before the end of the year, trying to get, the Fed governor job.
Yeah. I wonder whose dot this was at the bottom.
Yes.
I think it might be our repeat guest of the Forward Guidance show. Now we can say FOMC Governor Stephen Moran.
Yes.
That's an aggressive dot.
That's a very aggressive dot. But that's what it takes to delever this wartime debt. And the new mandate is here. It's front and center. And they're going to do by hook or by crook, get nominal growth up. And the funny part is that all the inflationistas calling for inflation have largely been wrong, I have to say. And I actually see, if looking at the break-even inflation rates, they're not going up. Oil hasn't gone up. I don't think housing is particularly like that frothy in terms of owner's equivalent rent. It's probably coming down. I think inflation coming down actually might happen, especially with a productivity boom that's happening in AI, which continuously looks like that's actually it's happening and it's real, rather than this is a bubble and it's going to roll over, especially with the financing costs dropping. So I don't know. I think whole new policy, it's a whole new framework. We're in a whole new era. It's taken people a lot of time to realize that markets are now a political utility, and they're not, just this 1980s, 1990s Gen X, boomer type model. Like, this is completely different.
Time value of money is dead. Quinn, what was your read on the Fed?
I like how if you control F, the word persistent in the minutes, you find it a couple times, and multiple times Powell says the case for there being a persistent inflation outbreak is less, and the risks of higher and more persistent inflation have become less. At the same time, they revised their 2026 dot for inflation higher. So the problem I have with Tyler, your explanation about this being a extremely deliberate policy decision and like the path forward in perpetuity, is because these policies are positive for the markets and liquidity, but they're horrific for the lower and middle class, which is who Trump and team was elected to help. The productivity.
Not necessarily. If the inflation for that substrate of the economy gets worse, yes, and to a certain extent, that's possible. I'm saying it's possible, but not if the productivity is there.
What does AI productivity only hurts middle and lower income?
It could keep the inflation, like if you can produce 10 units of goods a lot cheaper, then that helps the average consumer get things cheaper, right? I mean, we see it in oil and gas. I don't know. I'm just trying to play contra here. My heart says what you say when my auto insurance bill goes up by 20% this year. And I don't know, that's not factored in. I agree with you, but then you don't see it in the bond yields. It's almost like the boomers are subsidizing in the next generation's like crazy, asset accumulation in new things.
Yeah. So I guess my point is this resoundingly benefits asset owners and corporations who would be on the receiving end of benefits of AI productivity, who can then lay off people. I don't care necessarily to like go deep on, I think there are benefits to lower, small businesses when you cut the financing rate of the government. And so this also general, view includes some of the policies on the yield curve control stuff that they've been doing in ATI and things from the fiscal side. But I think that's where I struggle to be extremely I think the meeting was dovish. I mean, everything you just went through, Felix. The other thing I would add that I didn't hear too many people talk about was they revised down the unemployment rate for next year in 27, despite these horrific QCW revisions and the scare in the labor market. So effectively, they just created even more room to cut in a sense, because now what happens if these projections go to 4.8 or something? Like, I think I said it last week. I said that we can officially declare Trump the victor in his war against the Fed. And I think that's all this is. Like, that's what this is. The political pressure has succeeded, so undoubtedly.
Sure, this is from Augur. They do like an analysis of the FOMC statement, and just look at that dovish pivot. Like, this is just all guns blazing, I think. And my whole thing is, if you have this situation happening right now, where if you're actually fundamentally concerned about the labor market, which are some people out there who have like very significant concerns about it, you might consider these cuts to be, I don't know, somewhat neutral and just cutting off the left tail. But my view right now is that the economy is in much better shape than what some of this noise is coming from the labor market, which is so immigration driven. Like, Atlanta Fed GDP is starting to tick up to like 3.4%. You have retail sales coming out that is just surprisingly offside. It was an absolute heater of a release on retail sales this week. And this is the whole thing that I think is tripping people up, is that, yes, retail sales are a nominal metric. They're not real. But the situation now that we're in, where we're cutting so much into an era where we're nowhere near close to a 2% target, and now we're going to run it hot further, is we live in this nominal world now. So we're going to have this situation where I don't think inflation is going to reaccelerate to 6% or anything, but I do think it's very much entrenched, so much so to the fact that you're going to keep seeing nominal metrics like retail sales, like company earnings keep surprising to the upside, because we just live in this secularly higher inflation world. So you have that, and then you have what is going to be a lot more cuts coming through the pike. Like, it's just all guns blazing at this point. That's my read. Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Yeah, I'm totally the same. I think immigration has reduced the aggregate capacity potential of the economy. The break-even rate is definitely way lower than people are expecting, in my view, and they're cutting into what is still, by many measures, a labor market without any layoffs and still, tight. I think it's still the two-speed economy.
That's good for wages. Like, as long as wages are higher, go up on a higher.
I think so.
Basis than inflation. That's a good thing. You could be in this self-reinforcing nominal growth world that could be good for labor. I think that was to my point before. Check this out. This is slide 31. This is from Krinsky over at BTIG. But if we're talking about a rotation, like for the past couple of years, when rates were a little bit higher it was concentrating in the fangs. And now we're seeing, this is your patented cup and handle small cap potential breakout here was what we're looking at. So the cost of capital, we've been talking about this for months now, but like how everyone was shorting the crap out of IWM, and the short interest was enormous. It was like one of the biggest short interest in Russell futures as there was. And now we're watching it almost break out to the upside here. I don't know. My read is this could be actually good for all the small guys.
I agree with that.
I
think it did actually break out in the last hour. Yeah. Like the signal there today is that, IWM's up 2.5%, while Qs are up 0.9%. Like, and there's so much noise on Fed Day. To me, the real signal is the Thursday afterwards. And here we are. It's bonds are getting sold off. Equities are rallying, and small caps are leading the charge. Like it's game on in my mind.
Check out the next chart too. This is you guys will really like this one. There's a growing divergence between expectations for short-term rates and inflation. This is even before the Fed hit. And so the purple line is percent expecting higher short-term rates, and then the percent expecting higher CPI. And those usually go in line. I don't know. If I was a betting man, I'd say the blue line comes crashing down as when rates come down, it might oversupply the market, meaning like capital is commoditized and you can produce way more commodities by borrowing money at a cheap rate. So I think that's kind of a contra from where consensus is. But we saw during the time years ago when they brought rates down to zero, that actually caused a bubble in a lot of the oil frackers, right? They took out a lot of debt, oversupplied the market in oil, and it actually went to zero during COVID, which is kind of nuts. I don't know. Maybe that happens again. Maybe the high yield companies start pumping and, that comes crashing down. All I'm seeing is that oil's not moving at all with all this easing. Even you have 75 basis points of 25 and then 50 into the end of the year, and oil didn't move an inch. So
yeah, and bonds haven't sold off that much. Like if you told me what just happened this week, I would have expected to sell. So those are two big things I'm looking at and also dollar still, dollar's up today. It sold off yesterday. It's near the bottom of the range, but for what just happened this week, you would expect to see dollar way lower, bonds selling off, oil rallying, but it's been pretty muted. So I don't know if you guys have a good read on why you think that is. Are we missing something and there is greater growth concerns, or what do you guys think?
No, I think it's an exact repeat of last September where the market's scared to death of a recession that's not coming. And the dollar, I mean, you need like 8 Steve Morans on the board, I guess, to like probably puncture the dollar lower, because I mean, you have every cut possible priced in the market in the next year, basically. And, you have Europe and other central banks sitting at like just 1 or 2, 0 to 2 cuts, BOJ. So it's so hard to be more dovish of an interest rate policy here for the dollar. And then when you put that together with the fact that a lot of signs of the economy are bouncing, and if they are coming to the rescue this quickly, similar to the panic last year, you're going to get a reacceleration in growth, most likely. And so I think that's dollar up, that's dollar positive outperformance of the U.S. economy, and especially driven by, I mean, look at interest rate differentials. I sent this chart earlier this week, Felix. U.S. interest rate differentials relative to the rest of the world are extremely down. Massive, like kind of lows. They're extremely sold off. And so if you get a bounce in the U.S. economy here relative to the rest of the world, you could see, people coming back into the U.S. and that, a growth higher and yields have to re-rate higher and dollar strengthens off that. That said, I'm not like a massive dollar bull, but there's a huge dollar short. It'll be interesting. Although there's BOJ tonight, so 1% chance of a rate hike. So that'd be interesting if they maybe Bessent, because Bessent was chirping in their ear not too long ago, and one of the largest Japanese insurers said we're not buying any more Japanese bonds if until you hike rates. And so maybe they do that, and that keeps a lid on the dollar. But
yeah, the dollar is actually at a really precarious point. And this is what's fascinating to me is like, if you look at the long-term chart, it could just crash. The dollar could kind of crash here. It almost looks like it's breaking a pretty long downtrend, and I don't. What's crazy to me is that you'd expect global inflationary impulses to be higher, and I guess you're seeing it in gold, but you're not seeing it in other stuff just yet. Like the forward break evens I haven't even budged from 2-year forward break evens. I think are like 2.5%. They've just stayed there the entire year. So I don't know. I think that's really good for liquidity for emerging markets and the rest of the world, but I'm still not in the inflationista camp yet. This could just be like a really bull market and growth, and we have the lid on inflation and kind of Goldilocks to me for now.
Yeah. I mean, man, as we talk through this, it's just sounding more and more like what happened last year. Like you get the recession panic, and then you get this U.S. outperformance dominance move. Dollar goes higher, not because of a flight to quality and flight to safety, but because of American outperformance. Like, man, we just had the Bank of Canada cut rates yesterday, and the data up here right now is horrendous. Like we're right on the verge of a recession, if not in a recession right now. Like we've had the 2 quarters of negative GDP growth. We have unemployment rates still skyrocketing. Like we have deflation right now. Like I guess that's the thing, is that the rest of the world is just in a much worse spot than the US. And you're just going to have this same loop that happened last year where the US just outperforms as they rip it.
Well, I don't want to get too like Pollyannish about it. Like there's always going to be something that happens, like the carry trade unwind, or there's always risks there. But check this out. This is go to 33. So this is part of the reason we're seeing, you could say like a blow off top, but this is CDS on high yield. We've watched this for a while, but like I said, it's at lows, basically making new lows here. And then on top of that, check the next one out. This is all market structure stuff I look at too, but buybacks, gross and net buybacks, you have the first half of the year. This is the fastest, the largest amount of gross buybacks in the first part of the year that there's been, and no real issuance. The gray is the issuance of S&P supply. So not only do you have really salubrious financing costs on the debt side of things, high yield spreads are in. You can issue a high yield bond at 6%. I don't know why Schmeichel Schmailer doesn't just lever up the balance sheet, and anybody can go issue debt at a really advantageous rate again, and then go buy back stock or do whatever at this point, because the financial engineering you can do right now is just outrageous with where the capital structure, this capital arbitrage lies.
You just proved my point about who this helps, this policy.
I don't deny. Relatively, I completely agree with you. This is asset owners, etc. I just don't think that like giant inflation spike that absolutely annihilates labor will be there. I think relatively it might actually keep the system going, and you can grow new industries, and then their pricing power and the wages go up, and you have real growth. Like it might actually be that, but we got to watch that.
Lowering middle income class need wage inflation, and it's a battle. There's incentives are at odds to keep up. You need a massive increase in wages for the lower and middle income class who don't own any assets, and that's at direct odds with the incentives of corporates who are trying to maximize profitability.
And I central banks, like, the hard thing is that the existence of central banks is to make sure that real wages don't grow, basically.
Yeah. And so I think I'm pretty aligned with you what these policies, what they're doing and what they are going to do. Like I don't see how we tip into an immediate recession when they're putting down, especially with the Fed outlook of who's coming next. And, so I'm aligned. I guess more nuanced view with respect to the markets is that one thing that concerns me actually because of this is the concentration of Mag 7. And I think there's been a couple times in the last few years where markets have sort of gotten in a way imbalanced when small caps rip and it's wage inflation and all these things we're talking about kind of come at the expense of capital allocation to the Meg 7 that make up 30+% of the index. That chart I put Felix, page slide 26, I think, just shows the market caps of the Meg 7 names. I mean, NVIDIA over 4 trillion, Microsoft just under 4, Apple, So I think my view on the market is that the economy's fine for now, but I think it's a very dangerous place to be long Meg 7 is kind of my view. I think that...
What do you think's the trigger for that, though? Because, I mean, that's always kind of feels like the case, but...
The trigger could be one, inflation, could be a hot inflation print, because that would send yields up. That'd be a steepener, or weaker dollar or something. That would be bad. And then two, I just think that, I mean, we have seen a negative correlation between the dollar and equities over the last couple months, pretty strong. Dollar up, equities down. And so I do think there's a real possibility that the dollar's in a way bottoming here, at least for a bounce. And that could kind of start something. But so, yeah, I just think my point is that asset allocation is extremely important here. This is it's not a view that the economy, I'm saying I don't see an immediate recession, but I'm saying that the beneficiaries from here in the equity market, will be nuanced and reflect that. Look at regional banks; they're doing very well. And I'm saying that when we talk about equities as a whole, most people talk about the S&P 500, and that's basically Meg 7, and so there's risk there. And so I think asset allocation is super important. That's kind of my view.
I like that. What do you guys think about last time I was on here when we were talking about gold, and that's been just a banger trade, still doing well, a little bit of consolidation right now. It's interesting to see it sell off. I mean, just as you mentioned that as well around the dollar, like if we saw what happened yesterday, you would expect, maybe dollar lower and gold higher, and just based off the price action, like when you get quote unquote good news and you get the opposite reaction, that's always an interesting signal. So we had this pop in gold and then it reversed, and now it's just been bleeding a little bit. Like, where are you guys in that regard? And maybe we can separate the question for Bitcoin afterwards.
I think it's trading just fine. It sprinted up. It was way extended over the moving averages, and I think people were probably positioned into it. Maybe some people betting on Moran getting his way with 50 or other things being more dovish. I thought the meeting was very dovish and positive for liquidity. And at the end of the day, there's another, I forgot to put this in there, but there's a headline today. Germany will borrow about a fifth more than planned in the fourth quarter to help fund a surge in spending on infrastructure and the armed forces. One of the largest European countries just, we miscalculated by 20% this quarter. Like, I mean, come on. Like, I don't worry about gold at all. It's the only sound money out there right now. Japan's got like 3.5% inflation, economy ripping above expectations, wages growing, way above, like, and they're sitting with their rates below 0.5%, and they're like, we're gonna hike someday. Like, it's like, this is where I agree with Tyler. Is like, I just sleep so easy at night owning gold.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
That's the easiest secular play, right? Like, it's a no-brainer. What's incredible to me is, this is like years ago, Kirill Sokolov talked about this, but there's like, because of the market structure and all the passive nonsense going into like certain asset classes, gold has just been literally ignored there's no real gold funds out there anymore. Yeah.
Just ownership.
Well, there's one. There's certain ones in Austin, Texas. But anyway, my point is it's been so ignored for so many years, and now everyone realizes what happens when all central banks have to get to the end game, which is you have to print over fiat paper to bail out the system and with nominal growth. And we're here right now. It's just so global, and we're seeing global fertility rates dropping. It's all tied in together. It's like you need to get the growth going, and gold just sits there. It's the low volatility. The one thing that's puzzling to me is there's clearly some sensitivity where gold makes the move first. When the 2-year yield drops, gold makes a move first. And now we're seeing after gold makes the move, now the corn is like almost trying to follow it now. When there was, it's like this like yo-yo thing. I don't know what it is. It's probably like a FX thing that I haven't figured out quite yet. Global FX thing that's happening. But it feels like, Bitcoin's finally, moving out of this.
Yeah. Michael Howell's done some interesting stuff around that. And it does. It's gold goes and then Bitcoin goes after. And they very rarely go at the same time. And it's been an edge that's been pretty durable and consistent. Like I remember it as far back as the initial run in 2020 post-COVID, like gold started ripping first and then it was Bitcoin afterwards. And then we had this last year during that initial big breakout from gold. And then it's been going on this time again. And it feels like, the second gold has started to consolidate the last couple of days, Bitcoin started to move again.
Yeah. Someone smarter than us who's watching this, can you DM me the answer? Because I'll totally give you a plug next week.
Yeah. We need a quant.
It's the what not, no pun intended, muddies the water a little bit is that the fact that the largest buyers of the last few years have been treasury companies that are tied to the equity, risk premium and beta. And so I think that's where you get some of the multi-week, sometimes it's been multi-month dislocations and lags or what have you. Because I think so. I do think what's going on in risk markets matters a lot more for corn than it does for gold. But yeah, it's like we're not even to QE yet. We all know it's like, what are we, like the third inning, fourth inning of this? Like maybe the second. Yeah. I don't know.
I will still the chair, and like that's changing soon. Like, man, yeah, you really just gotta sit on your position. And like to your point, gold is a comfier hold for me right now because it's so clear. Versus Bitcoin, I have to navigate the treasury company stuff, and like some of those companies are trading at a discount already. Some of them, I think MicroStrategy is at like a multi-year low right now in their MNAV, so they're not really doing much either. So you do have to discount how much is in the price in terms of how much they've kept a ceiling on it, and so that gets a bit complicated. I still see the fundamental bull view for Bitcoin, but it's easier to sleep at night with gold right now. I do say that.
Yeah, it's like a 13 vol or 14 vol or something.
Yeah.
Like crazy.
Yeah, and it's outperformed since July. It's outperformed since February. It's outperformed since March of 24. It's outperformed since 21. It's just like it's a fourth of the vol, and it's outperforming every asset. Like you have China, the central banks bidding this thing. It's so clear.
So here's the greatest side is that like all the gold guys that are all like 60 years old. It's like Rick Rule and Sprott and Grant Williams, and they've been waiting for this bull cycle of golds for like 25 years that like has just been hibernating. And now all those funds have pretty much shut down, and there's no one else running money in gold. Yet, the largest central banks in the world are buying it. It's such an easy. It's an easy.
Dude, that's how markets go though. Like that's going to be the generational bottom in value is when the last value shop closes down, or when like Howard Marks gives up on distressed investing or something.
Wait, I want to bring this up because this guy we talked to this week, his name's Hunter Hopcroft. He writes this Substack called Lewis Enterprises. This guy's absolutely brilliant. Love it. I want to have him on the show at some point, but I just want to read this. He wrote this piece, and it basically nails market structure. Like there's people out there that are just like wildly smarter than us and probably should be famous, but I don't know. I always say talent recognizes genius, but mediocrity knows nothing higher than itself. And like, I read this guy's stuff and it's genius. And so here's a little snippet from it. I'm just going to read it. He writes, said differently, equity markets have become a luxury good accessible only to companies with mimetically derived equity multiples, businesses that capture investors' imagination through AI narratives, levered crypto trades dressed like businesses, or with highly promotional management teams. And then he talks about the mathematics of market dysfunction. He gets into why this is happening. The financial logic driving this migration becomes clear when examining cost of capital dynamics. Considered a hypothetical middle market company trading at 16 times price to earnings, hardly an unreasonable multiple in today's market. For this company needing $200 million in growth capital, the math is unforgiving. Equity financing at current market cap conditions implies a cost of approximately 11.7% using standard CAPM calculations, plus the impact of 12% ownership dilution. This translates to roughly $23.4 million in annual financing costs while permanently reducing existing shareholder stake. Private credit at 8 to 10% rates, by contrast, costs just $16 million annually before tax and benefits. After accounting for the tax shield from interest deductibility, and after-tax cost drops to approximately $12 million. The annual savings of $11.4 million create a net present value advantage exceeding $43 million over 5 years. Basically what he's saying, and if you go to the next slide, you can see how much money is in private credit. And he's essentially saying, like, no one in equity markets gives a shit about the middle market company. So this is because of the tax advantage of private credit. Companies are staying private longer and just accessing the debt markets at higher rates. And it makes sense because they're not diluting their companies, right? Instead, if they went public, they would really dilute their companies, and instead they're staying private and there's access to capital there. And it makes all the sense in the world. The only companies that, you know, the equity market wants are these popcorn meme stocks and crazy crypto shit. So it's like art mimics life, life mimics art. So you have this market structure where, like, you know, the super wealthy that just own all the old shitty, you know, low volatility assets that the policymakers have to bail out, and pensions and endowments. And then, you know, the financial nihilism stocks, which really is a rational response for all the retail investors that are getting eaten up by the inflation. So it's like, but the real reason this is happening is because of, it's very simple. This guy puts it out, is it's a dilution thing. People just want to stay private because they don't have to dilute their companies as much. So it leaves this dearth. And then all these value managers, you know, to bring it all in circle, they just are getting chewed up because, like, no money is going to the value stocks. And it's like this barbell thing. And it really is, you know, the best of times and the worst of times, right? No one cares about the boring businesses anymore.
You got me thinking about something because it was something we spoke about last week on the reflexivity, Tyler. You know how I was saying, like, everything's hunky-dory on the surface, but the underneath is so unhealthy that the reflexivity in both directions is immense. And it just goes to show how, unhealthy the underpinnings of this are. That's not saying people will say that's like overly doomer, but it's like, it's just true. We all know that. So one thing that I find super interesting is, like, every day I wake up and see an announcement of NVIDIA buying a stake, investing in someone else. Like, what is a worse sign as an equity holder or like a bag holder than to see a company you own throwing their equity around like it's monopoly money, because they know it is?
Yeah, it is monopoly.
It's literally monopoly money. So why? I mean, it's smart on their part to get other things worth value for it when it's so elevated. But I find that to be like something no one's talking about, where it's like, to me, that sort of, I mean, the chart looks horrendous, and I would sell too if it's a $4.3 trillion company and the CEO is just handing out cash to everybody and their brother to perpetuate, you know, oh, we'll backstop CoreWeave. Oh, we'll invest in Intel. What the heck? Like,
it might work. I don't know. Jed's stupid.
I mean, look, I want the inside tips on whatever Trump's going to announce next, and I want to invest in that too. But, like, I'm just saying the optics of it, like, aren't great.
Okay. Oh, and I just got to read this last part because this is where Hunter nails it. It says, Perhaps, this is slide 39, perhaps most concerning, this trend may be self-reinforcing. As most companies abandon public markets for private arrangements, equity markets lose depth and diversity, becoming even more selective and dysfunctional. The result could be a permanent bifurcation of American corporate finance, a small tier of public worthy companies trading at premium valuations, while everyone else operates in parallel private capital ecosystems. The $500 billion in private credit dry powder signals not an abundance, but a desperation. Capital desperately seeking deployment because traditional channels have broken down. Default rates remain low at 1.84%, suggesting that these aren't inferior credits being rejected by discerning public markets, but quality companies forced into alternative arrangements by dysfunctional pricing mechanisms. Apollo's Mark Rowan has explicitly talked about this. But so this is exactly to your point. It's just like, this is the problem with the market structure. I mean, someone needs to go to DC and talk about this. And like, it's probably this guy and not me. But this is what happens when you've basically created a cartel of passive management, and it will go in these popcorn stock meme mania. It's just going to keep happening, especially when they're lowering rates. It's just going to keep happening. And what's going to happen is the markets will reset, and eventually the relative performance of your dumb retail traders that are absolutely crushing everybody right now will move back to money management over there instead of this passive over diversification that just chokes floats and 401k, subsidized like flow system. Like the whole thing is just broken because boomers mandated things, and the road to hell is paved with good intentions. Like, we're seeing the effects. The one last thing I'll say, and I'll just shut the hell up, is I wrote a tweet today and it was like, we're watching this Fed easing is essentially what it really was. If you just want to tell the truth, is it's bailing out the boomer pensions, endowments, and life insurance companies. The commercial real estate office was absolutely annihilated. Single family homes aren't hitting a clearing price. And so you have to lower rates to basically bail out all these pensions and endowments that own dog shit, low volatility assets, right? Like, if you actually let the market at a reasonable clearing rate happen, there's no bidders in the market for houses. Like, you guys can't fucking afford a house, right? It's I shouldn't say that. I don't know, but like, where interest rates are, you wouldn't buy a house at the interest.
It doesn't make sense to buy
the clearing rate is where rents are. Everybody in these cities is getting. If you wanted to buy your place, you're paying 2.5 times your monthly payment. You see it every listing. You see listed for sale, drop, taken off market, listed for rent, drop. Like, no one can transact.
And so that, I guess that's my point, is you're bailing out all the system of boomers that own that shit. And that just becomes a tax on the next generation. Fortunately, I've changed my mindset, and you should too, which is, I'm talking to the viewer, which is you can actually play jujitsu and take advantage of this market structure, right? You can actually do this yourself. And you have to invest in differentiated things. You can't just do the whole stupid, like, get your Northwestern Mutual guy that says, we're going to put your funds in blah, 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 and spray and pray. You actually have a choice now, and you can concentrate your portfolio. Just make sure it's not in frauds. Like the other problem with lowering rates, it ends up in, there's real entrepreneurs that are doing real things. And then there's 10 fraudsters that come out and do a SPAC that's full of shit.
Yeah, but frauds are the top performing asset class year to date under Trump. What do you mean?
Well, that's what I'm saying. Is like, you kind of, if you lose money in that, you deserve to lose money eventually.
Yeah. Right? Yeah. What's so interesting is hearing about that whole trend where the public markets at TradFi are going to more private, but then we have going on in the crypto world, which is that they've been taking private companies and trying to basically get liquidity for them until they basically become a public company. You've been seeing this with Robinhood has been coming out with it too, where they're trying to basically create liquidity from private companies where you can own basically some sort of derivative of a private company like OpenAI within their platform. And you just have this weird combination of hodgepodge where it just gets super messy and confusing.
Well, that's because Tyler's talking about cash flowing industrial businesses that are real companies that are staying private because their owners are like, I want this cash flow. And the other one, you have scams, Ponzi's, grifts, and all the like,
getting liquid,
who need the exit
real
liquidity
businesses are the ones. Yeah,
exactly. So our public financial markets, exactly what Tyler said. Go through the list of the last IPOs. Gemini hasn't turned a profit literally ever. All these crypto companies that don't make any money, never have, the AI, like all these grifts, like
in their defense though, dude, so did Bezos did that for years too. And then that turned out to be,
look, their incentives are to go public and get liquidity. I'm not saying that's wrong. I'm just making a comment on the state of the public equity
IPO market. They don't want to supply it. And it's it's terrible for our economy really, because it hollows
capital misallocation, and it goes to shit versus productive.
Yes. Yeah. We don't have real companies that do real shit. And that therein lies, like, you can make the argument that this last 20 years was just a movement. You moved capital from one part of the, substrate of the lower middle classes to the upper class just by financial engineering, fiat financial.
That's like the Peter Thiel argument, is we haven't actually created anything new. We've just financialized things.
So that's the problem. And that's why you even hear stories of the dollar and US demise, because it's the definition of first world problems. Everyone's just watching their 401k go to the moon. Meanwhile, there's no actual innovation happening. It's just liquidity pumping the assets going up. And then that's how you get. So
it's a fake economy.
It's like, it's just literally the definition of our markets.
That's the thing. You got to play the game. You got to play it. Like, there's what should happen and what is happening. And that's where we're at.
The
Is that part of the onboarding?
At some point, you have to produce real things, right? Like,
yes, there will be a day where, you can't just keep putting Morans on the Fed board and solving all your problems.
And I will say this, to be more optimistic, first turning, Pippa Malmgren just put out like a new newsletter, and she said that, like, this stuff is mind blowing. First off, she said the government possibly might release. She was very coy, but said might release the fact that there's new technologies the government's had for years and years and years, and they might release it to the private sector for once. And they've been holding it back, the physics of all this stuff. She mentioned, I think she said something like, we can manipulate space and time. like time travel. I don't know, but it's wild. And she's not a bullshitter. But like, could you imagine if like these actual physical breakthroughs happen and they've been holding this back for a generation?
I would love to time.
I'll believe it when we get the Epstein files, bro.
Yeah.
Dude, I'll believe it. I think there's crazy stuff happening. I'm so excited. This next 10 years, dude, it's going to be like, oh, all the things that we thought were true are just like complete horseshit. It's going to be an enlightening. And it usually happens if you look at Girardian theory, when a figure gets killed. And that's what we saw when the new social contract arises, and like everyone starts adding up this new thing. That's the Charlie Kirk death symbolizes that in that Girardian philosophy. But I don't know. This all ties together is what I'm trying to say. I'm out there right now. People just turn me off.
Get out of here. No, I don't.
I think one thing that's really stood out to me, and you really actually coined this, Tyler, and harped on it, and then all the dots connected for me. But I think the biggest shift in the next number of years in the U.S., like politic and cultural, society, will be politics moving from a party game to a class, and therefore, by definition, because class is like nearly 1-to-1 correlated to age, generational game. And one of the things that you're seeing, for example, how often do you hear these days, people say, respect your elders? That's sort of a thing of the past that, like, boomers, I think you should respect your elders. But I'm just saying that sentiment is diminishing because of how much the older generations have pilfered the system at the direct expense of these generations. And so I think that's what we're seeing is politics moving from a left right, because you're seeing Trump and Bernie Sanders actually have more some policy similarities or more than others, and different things like that. And you're seeing policy move to generational divide and class divide, and that's ultimately where, like, I think hope is found, because
I was remember the liberal policy was supposed to be. It was like the liberals were the party of labor, and then all of a sudden they just decided not to be. I don't know. They got co-opted by the corporatists.
Yeah, they're the party of Silicon Valley.
The thing that I think resonated really a lot with me that Charlie Kirk said in I think it was the Tucker Carlson interview. I had no idea about any of his stuff. I don't know if I ever listened to him. And then I listened to a bunch of his stuff after. But he basically said his main goal is to bring people together, have conversations, and de-radicalize. His job, he's like, my job is to, like, and I've been hearing this more and more. It makes so much sense. Like, people are so aligned more than you think on both sides on what needs to happen. And it's simply the ruling class that is preventing that from happening. And so if your day-to-day discourse is about bringing people together and bringing people closer and de-radicalizing, because at the end of the day, most people are aligned in what needs to happen. Like, you can be making money off meme stocks because the system's a Ponzi, but then also be saying, like, yo, this is messed up at how unfair the
world. Yeah.
So,
you know what makes me
I think
feel
that's
better?
what I liked.
I think there's these guys that write this Rational Optimist newsletter. I got to plug them, Stephen McBride and Dan Steinhardt. And I read this thing, and it's so well done. And they just talk about, like, entrepreneurs that are doing real cool things. It'll be like stuff you never even heard of. And I read it, when there's a new article that comes out, and it feels so good. And I think that's really what our generations really want, is we want to root for winners. We want to root for people who are pouring their heart and soul into, like, something, into a company that's really doing real stuff and not just extractors. And I think that's what drives me nuts about the boomer system, is that it's a lot of extracting value rather than really putting risk on and growing something with your heart and soul. And that drives me up a wall when it's just like, I want to get mine just by taking from you instead of, actually creating something and doing something. And so shout out to these guys. I think guys like that will lead us out of this nonsense, weird environment we're in, and we'll regrow the economy together.
Honestly, I love that name, Rational Optimist. I feel like we should try to adopt that theme here.
Rational Optimism. Yeah.
Love it. All right, guys, I think we can wrap it there. But good chat as always. Yeah. So good to have all three of us back here.